Good morning. Welcome to the morning market briefing. Today is Thursday, March 12th, 2026. I hope you are doing well. The weather's really turned out here in Marietta. It was 80 degrees, I think, at one point. Allegedly, yesterday I did not go outside. But today it is not 80 degrees. It was actually about 68 degrees this morning. And then by the time I came back to the office at around 7, it was already in the 40s. So things are changing quickly, and they're not changing in a good way in Iran. And a quick update on the fighting that's going on. There's additional strikes on Dubai, 2 tankers in the Persian Gulf, a key export terminal in Oman were hit overnight. In order to stop the fighting, Iran's President Masoud Pezeshkian says that he wants firm international guarantees against future aggression as well as reparations. So that's kind of the conditions that he's laying out. Guaranteed, Trump is not going to be flying a 757 with hundreds of billions of dollars over there in order for Iran to stop the fighting. So he can kind of wave the reparations goodbye, but it also means there's not going to be an imminent end to the conflict. Energy Secretary Chris Wright has pushed out the timeline for ship escorts, naval escorts of tankers in the Strait of Hormuz to weeks. So he says by the end of the month, we want to have escorts in the Strait of Hormuz, which I think when it was first announced, it was thought that the escorts were going to happen immediately. But now, we're talking about not until the end of March. So that's difficult, and it means that oil prices are up 6% this morning, back to over $90 a barrel. And we're beginning to see some gas lines, Tom. Super producer Jonathan Hicks went to no fewer than 5 gas stations this morning. And it wasn't until he hit the 5th one that he was actually able to get gasoline. Hicks, how much did you pay for that gallon of gasoline, by the way? $4.30. He's a premium.
Yeah.
His premium gas. A
lot of people are saying.
But this is going to have significant impacts too on obviously travel. People are going to look at their flights and say, "There's no way I'm traveling." Not only because it's dangerous, but also because it's very expensive. So it's more dangerous, more expensive. And this is why airline stocks are notoriously bad positions to hold.
What about war in the Middle East would make flying more dangerous, Ben? I'm not sure I'm following that line of thinking.
There's also some reports yesterday that there was a potential for a drone attack on California from an unidentified vessel placed by Iran off the coast of California. So there are things that are increasingly hostile, and Iran seems like they're increasingly willing to go to more places and do more things than perhaps they were at the beginning of the war.
It's good. Get out of the house,
So I think all of this just kind of means that whatever hope we had kind of over the weekend that we had a taco trade on, I think that trade is still on, but the Strait of Hormuz is getting tougher to figure out. I mean, I've said before, and I continue to contend, that as long as Iran controls the Strait of Hormuz, which they do, just because of the numbers. I mean, look at the ships that have gone through. I think there's been 5 ships that have gone through. They're all Iranian tankers, and no other ship has gone through. So that, to me, if I look at the data, not the narrative, Iran controls the Strait of Hormuz, and as long as that continues, they're going to have the continued market volatility. So I think that the pressure is going to increasingly be on the U.S. administration. The more Jonathan Hicks is out there who aren't able to get gasoline, the more up in arms that people domestically will get, and that's not good. That's not going to be good for the administration.
I mean, you should be worried if Hicks doesn't have gas. That means things are going really wrong.
Indeed. Tom, any further thoughts that you would add on any of this? I know bonds actually getting a little bit of a bid this morning, tiny, but you would have expected bonds to be selling off more given what's going on with oil.
Yeah, we saw yields ramp up overnight since, I don't know, the first time I looked, call it 6:15 this morning. We've come back maybe 4 or 5 basis points. We're still above 420 on the 10-year. I would say it's still pretty opportunistic, to move out a little bit on the curve. But for right now, I'm actually happy that we are net short duration and that we're still rolling through a lot of the bonds we bought 2-3 years ago that were much higher yields. It gives us a lot of flexibility, and I think that you'll probably see plenty of those bonds mature and go straight into equities as this thing continues to bounce around because, bonds have continued to outperform stocks year to date, not by a lot, even with the sell-off. But, if you're flat on 40% of the portfolio and down slightly on the 60%, then you're going to have to start flowing cash back towards the 60 to keep asset allocations tight. And that's what we're here for. That's the whole point, and that's how you become a little more robust in times like these is swinging one way or the other on the asset allocation as a function of how the portfolio moves. So I think it's probably a good thing. There's been a lot of dynamics in the portfolio. I'm happy with how things have gone. I don't love the whole situation with the war, but I think that you think back to all of the major crises we've had over the last 10 years, and there's been opportunities like this many times, and you think, man, I wish I'd bought. And the tough part with things like 21 or 22 when the war in Ukraine broke out is that yields were very low. There weren't a lot of opportunities on bonds, and so you couldn't swing back and forth and make awesome buys on both sides. But now I think that's really in play, and so I would expect to see a lot more active trading in portfolios this year.
We did have a conversation with a super user yesterday about actually adding to his fixed income over time because of the attractive yields that are out there, and our view that inflation is less of a systemic issue, in part because, in fact, almost entirely because we're not printing money like we did in 2020. I think people talk about inflation's coming back because of the war and because of all these other things, but look at the money supply. That was what drove inflation, and look at the money supply today, and it's two totally different realities. And I would just point people to the CPI number that we got yesterday. Yeah, it was a little bit lower and probably go up next month because of the oil prices and things like that. But you look at that and it's fairly benign. You look at the budget balance that was in line with last year and is actually down $30 billion on a year-over-year basis, even though they said that the one big beautiful bill was going to blow out the deficit. We're actually running $30 billion ahead of last year in terms of a smaller deficit. So that's good news. And this is when all those tax refunds are hitting and we're at war and things like that. And yet the budget deficit is down.
We got trade data this morning for January, and the trade deficit was expected to be negative $66 billion. It came in at negative 54. Export prices up 5.5% month over month. Import prices down 0.7. So that continues to be a positive thing. The tariffs were the cause of all the problems last year at around this time, and those are being a net benefit to the deficit right now in real time.
And there are some news on the tariffs, but I think that we're looking into trade probes of a number of countries, including China, Mexico, the EU, India, et cetera. These are, in my opinion, there's Section 301 probes, which is basically saying that these countries have built way too much excess manufacturing capacity, which is subverting our businesses. And essentially what this does is just legal justification for the tariffs and for the trade deals that have already been enacted. So I actually don't think that this is new news, but it is going to give a little bit more legal backing to the tariffs, which we all knew was going to happen over time anyway. So that's why you're not seeing more freak out about this tariff news. Plus, it's kind of getting buried with all the other headlines.
Yeah, it's not interesting now that oil prices are up.
Yep. And then if you look at CEO confidence, and I think that the extension of this war probably won't help that, but we did get CEO confidence numbers out of the Business Roundtable yesterday. And this is some of the largest companies, 150 largest companies in the United States. It was conducted from February 23rd through March 6th. So it was after the Supreme Court ruling on IEEPA tariffs and during the breakout of the Iranian war on February 28th. And I was very surprised about the strength of this data. Overall, it was CEO confidence numbers really improved. But if you look at the internals, that's where it really is interesting. Hiring plans increased, but it still remains very weak, going back all the way to 2012. But expectations for sales was up 6 points. And so pretty much back to the highs of 2021. And this time there's no 8% inflation. So this is actually 6 points of real growth on the sales side. And we're seeing that from companies as well. There's fairly optimistic growth on optimistic guidance on the revenue numbers for a lot of companies. And then finally, the plans for capital investment increased 12 points to a value of 91. And I mentioned this is the highest level since early 2022, and that's a long time, 4 years. I know 2022 seems just like yesterday, but we've had 4 years since we've been in this higher interest rate cycle, and we're only just now beginning to see a bit of an improvement in CapEx expectations. What's notable here is that I think this is the first time I've seen real data outside of data centers where CapEx expectations are going up. And I think that is good news. Now, does the war in Iran change a lot? It may, but you can see that the underlying thrust is that people want to invest.
Yeah, I mean, there's a lot of green shoots, and we got housing starts this morning too. Month over month, new housing starts is up 7.2%, and that's because rates have come down. They may be elevated from where they were last week, but they're still net down. We're seeing, mortgage applications tick up 2 weeks in a row. I mean, there are green shoots around. We just happen to be hitting those green shoots at the same time that we started actually shooting at other people, and that is a problem. Though that being said, not a green shoot. New York put on negative watch by Moody's this morning, which is when you see that on a major city, that's usually give it 90 days. You've been put on a performance improvement plan. And PIP. So they cited sizable and persistent expected budget gaps.
This is New York City or New York State?
New York City specifically. So we've been really not adding there for a long time. A lot of the bonds we have there are older, going back to COVID when they got, blown out because no one was riding the subway and everyone moved to Connecticut. They've since come back from that. I mean, the prices are elevated from where they were, but I don't expect us to be adding new New York City bonds anytime soon. And there's supposed to be testimony yesterday afternoon. Mamdani was supposed to appear and discuss the reasons for, the budget downfalls, but he canceled due to he was fasting for Ramadan. So I guess we'll find out what's going on with the budget sometime in the next month or so. Not great. But that came out pretty much immediately after Moody's came out and was like downgrade or negative watch, which, is a harbinger of doom.
It's get out while you still can.
Yeah. We're going to give you 90 days to reconsider. So, I mean, they are AA2. It is still one of the most heavily taxed and heavily populated cities in the United States. So I'm not going to say it's going to default anytime soon, but they're in a real pickle. And unfortunately, the pickle maker is busy. So
there's a good Seinfeld episode where they go into a movie in New York City. And I thought this was apropos because the title of the movie was Prognosis Negative.
Man, how many episodes of Seinfeld involve going to see a movie?
Quite a few.
There's a lot. There is a lot of movie going.
Yeah.
That's why the 90s is better. Going to the movies is the best, man.
Company news, Eli Lilly is warning against compounded tirzepatide plus vitamin B12. So if you get your compounded weight loss drugs, GLP-1 drugs, just be careful because there is a chemical reaction that occurs in them, which can be pretty harmful. So just be mindful of that. Obviously, Eli Lilly has a vested interest in this because they don't want compounded drugs competing with tirzepatide. So I think it might be a little bit of convenient data, but nevertheless, I think there isn't. The nature of compounded drugs means that they haven't really been studied or FDA approved. So I think that that's something to be mindful of. And then Dollar General down 6%. They had an excellent Q4, but the momentum is definitely getting dented a little bit by the guide. They expect just 2.5% same-store sales growth. For context, they exited the year at 4%, 4.3%. They saw growth overall. They saw really good momentum. They saw really good momentum in seasonal. That accelerated to 8.2% from 5.5%. Saw growth in home products. That accelerated 8.6% from 5.4%. And even in apparel, at Dollar General accelerated from 2.4 to 3.5%. So,
speaking of Seinfeld, how are the shrinkage numbers?
Shrinkage numbers were phenomenal. Lower shrink, higher inventory markups, and lower inventory damages. So people dropping some of their products a little bit less, I guess.
Throwing the cans on the ground and then trying to get a discount. Gone down.
So overall, really good quarter from Dollar General, great margins, but I think people wanted a little bit more from the guide. If I was Dollar General, I would have guided exactly how they did. It's right in line with their long-term forecast. They have higher comps they have tougher comps this year, and they serve rural communities. And in those communities, they're going to be more sensitive to gas prices. They drive longer distances, and they tend to have gasoline be a larger portion of their budget, certainly than in New York, where you're on the subway. So Dollar General is, I think, probably going to be under pressure the longer the gasoline prices stay high.
I mean, counterpoint, they could see a shift down from people who are at Walmart going to Dollar General as a result of gas prices, potentially.
Yeah, I would agree. But some of these communities where the Dollar Generals are, they don't even support a Walmart. So it's kind of like they're the one-stop shop.
Yeah.
Now, Dollar Tree, I would definitely agree with you on that. But, yeah, I mean, I think that you could see some downshift. It'll be interesting to see what happens to this store because they've been such an excellent performer. We'll see what happens.
Until today.
Yeah. So we'll leave it there for now. If you have any questions, please do call us or let us know. We also want to remind everyone of the Jacob's Ladder Lunch and Learn event on April 1st. Again, if you want to learn any more about that, we're really, again, trying to promote their any ties or connections to the healthcare industry, the education industry, or the fundraising community, all things that we feel really passionate about. And I know the operations over there at Jacob's Ladder are passionate about that too. One final note on super producer Jonathan Hicks. I was just going through the comments. He ran 10 miles a couple days ago, and I was going through the comments on them because I was going to comment very strong
on Strava.
And unprompted by me, a person commented, "So powerful." And
wow.
And really, there are no two words that better define Hicks as so powerful. So thanks, Hicks, for all that you do. Thank you, Jacob's Ladder, for all that they do, and we'll see you tomorrow. Bye.